earnings, the run from 23 to 30 was them kicking their open obligations to October. Maybe. We'll see how October shapes up. I'm disappointed in GameStop's management not dropping good news. I mean, what do they have to say? Always the same amount of bullish. Well, we don't know if there is any ETF rebalance settlement, right? That's just speculation that the ETFs, there's a chance that the ETFs were overlent, right? And that they would have some sort of obligation due to the split. I don't think there's any guarantee of that price action though. Like that's an obligation that we can't even track. Like we can't even prove that it exists. If it were a thing, I mean, it could play out over the next like 2 days. I'm not sure about MSCI. It seems to be kind of all over the place, but there's not a lot of GME in there anyway. But you know, Russell 1K and S&P over the next 2 days for their ETFs. Worth waiting for an IV bump? It might be. Yeah, the 50s got crushed a little bit. How do you think they keep dodging OPEX? I don't know. It kind of seems like what we were talking about, that they just walked away. There's just no, like, if they don't generate obligations, they don't have any to cover, right? And the period in which we see them generating obligations isn't sufficiently far from the next period of covering. So if we think about it, like, here, let me pull up the chart 1 second. I'll try to show you kind of my thoughts on this. It's hard to say though, because I can't say I'm right that they've walked away. It does seem like they did. But if we consider these downside periods of shorting, right, of like massive shorting and synthetic share usage, let's look at the local one. You know, we're seeing obligations like built up into an OPEX period like January, right? And we're seeing them covered out in March. And then, you know, we're seeing them built from end of March through May and then covered in May. And then I think they stopped, right? Like, they just stopped shorting. Stop shorting volatility, stop shorting the underlying. I think through this period, they kind of just developed liquidity in order to get, you know, the borrow rate back down, which they have. And in order to, you know, stabilize the price action of the stock. Because after March and May, when we were hitting those like 100% borrow rates, you know, things had obviously gotten out of hand for them. And then with the split on the table as well, the best solution would be to walk away from the risk. And then we're seeing, you know, another sustained period of shorting showing that they have returned. But I don't think we've had sufficient time from this period of shorting to our, you know, next obligation period. So, you know, the sustained shorting into the bottom looks really good for OPEX because that's what we expect, right? We expect this move down into an OPEX period. But I don't think the period of sustained shorting is sufficiently long. I mean, to me, this looks more like this period than it does, like, especially now with the price action of this week. It feels more like this period than it does like March. And that's tricky, right? Because this throws all the right signals. And, you know, we're seeing overshort, we're seeing huge amounts of puts bought. But if they just walked away and didn't generate any significant obligations during this period, then we have this huge gap in the timeline for GME, where we just have no obligations generated, which would explain why like August had no volatility, and you know why we saw ETF FTDs occur here, but we didn't see any ETF FTDs occur for beginning of September, right? Which would, you know, have been generated back here. And so if it's as simple as that, I mean, that's great for the future, especially if they've, you know, returned to shorting, but not good for the near term, right? Because that could mean GME prices below 19 before we see any covering cycle. We'll see though. I mean, we have some time in the period of stabilization here still. And, you know, potentially some time still to see upside. So 10, 20, 30% VUPs in June, but very stable, right? Like very low obligation generation. And yeah, we saw upside, right? But there wasn't really any short generation creating that upside. You know, I think a lot of this period was still clearing out obligations created back here. And they did. They succeeded in getting the, you know, the borrow rate down into back into a manageable level, down around like 6 to 10%, right? From our highs here of like 100%. So, you know, it took them a while, but they did get, you know, that liquidity back and back under control. I mean, that's the risk with doing these positions on GME or any of these other stocks is that, you know, when you run out of liquidity, if pressure comes in, you're in a very risky spot and you have to unwind that pressure somehow. No, I didn't sell my October calls yet. Because I'm still gonna wait out the possibility. I think with the October calls, I'm gonna wait out the possibility of the split generating obligations. So at this point, you think they can control volatility at any time? I think they've always mostly been able to. Good cat AMD SPY entries for Vuppies. Now that the rate hike is out of the way, seems all-time low. I mean, I'm already in AMD quite a bit. I have cat positions, some that I bought earlier in the week, some that I bought today. I stopped out of all my October calls. I know they killed Ivy. Anytime you get a weekly sell-off like that, Ivy's gonna crush out. It can bounce back though. And my IV entry is really low, so I don't really mind holding through it. I'm willing to take a small loss to find out what happens over the next couple days. Does a drawn-out recession, stagflation, naturally reduce volatility? Sure, but we're in a bear market, right? It reduces liquidity because you have fewer participants. I'm an upstart. Any potential for October call still? Yeah, I'm mostly because it's more of a like less OPEXy. I mean, there has OPEX price action, but it also just has periods of, you know, upside growth in it. It's a pretty liquid stock, and a lot of people buy it. Upstart is still on Reg Show and still has a shitload of FTDs. I'm gonna stay in Upstart. I have I have lots of calls there though. I have October, December, and January. What if I remove Guybrush and then we rip? I'll remove the angry banana. All right. quick, make me a mod. Time to shut down the Discord GME channel. No. We'll be alright. Aren't split obligations due in October? 3 months from the split. No? That's not, I mean, that's not how forward contracts are written. They're written to quarterly expirations. Stickle for the VUPs. Works every time, 40% of the time. We'll see what happens overnight. You should remind everyone not to over-position. What's with the crazy SPY ripsaw action? This is the craziest afternoon of ups and downs. I mean, lots of repositioning. And we don't know where it's going to settle out until we start to see some OI prints. Is there a reason to think that the counterparty when using CNS is the NSCC? I mean, yeah. So when CNS is used, there's no new obligation created because the NSCC counterparty is each side of CNS. I mean, CNS just destroys the obligation, right? That's why low volume's bullish, because low volume means it makes it harder for them to clear obligations through CNS. How's the possibility of no OPEX runs change your CC strategy? I mean, I just keep selling them. You know, I own a bunch of other stocks that don't have OPEX runs, and I just sell covered calls on those. I don't think we're beyond OPEX runs, but I do think that, you know, the split and the liquidity generated therein could have at least slowed down or paused the cycle. I think they got the fuck out. Honestly, like, I think they got the fuck out before the split happened. I think we saw them cover up remaining obligations from the time the split was announced in March, and then especially after they changed the corporate charter. I think from the time they changed the corporate charter through the split, they covered all their outstanding obligations in order to not have a deficit. And that's why we saw, you know, that consistent rise in price. Like, this was just them exiting, right? And then I think after the split and after the last of the ETF obligations were closed out in August here, I think then they started shorting again. So if you consider they reset their whole position to 0 here, then this shorting won't generate obligations for, you know, a couple months. Why would they short if they were out of their obligations? Because the volatility on GME remains attractive. GME is illiquid. It generates large amounts of volatility.